Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is VideoCast episode 83, podcast episode 73 for the week ending May 21st, 2021. Great to be with you. As always, we're going to start with some media spots, cover some key points. We've got a lot of Ask Me Anything questions this week we're going to get to at the top of the episode, and then we're going to go through quite a few sectors, quite a few notes, so grab a pen and paper if you can. If you can't, just listen. We're glad you tuned in, and hope you enjoy. But action-packed this week, so stay tuned. Here we go. First off, want to thank Liz Clayman and Ellie Terrett for having me on the Fox Business, the Clayman Countdown on Tuesday. We were talking about the 13F large hedge fund filings, and Liz asked about Michael Burry's short on Tesla, Warren Buffett, and Cathie Wood's portfolios, and who made the best trades for Q1. Now, with Michael Burry, there were headlines out that he's short $500 million of Tesla. That's not accurate. That's the notional value of the options. As I said in the segment, which you can find at hedgefundtips.com, he may have a few million dollars of premium, at most a few tens of millions of dollars of premiums, but it's that's his maximum risk. The notional value, if Tesla went to zero, would be $534 million. He's a clever contrarian. He got the housing crash right in 07, 09. He's got some things wrong. He's right more often than he's wrong. So definitely worth paying attention to. However, this was a Q1 filing, and if you recall, Tesla dropped from like 900 to 600, so he may have taken a ton of profits, probably 5 or 7x on the options already. Maybe he's holding it till death, like Chanos, tries to hold things till zero. I think take a win. I wouldn't bet against Elon Musk long term, irrespective of valuation. The guy's like a cat. He's got 9 lives, and he is the Thomas Edison of our day. I have actually 0 positions in Tesla either way, never have, but a fan of the guy and his thought process and some of the things that he's done. If you want to argue about valuation and everything else, that's, I'll leave that to others. But this doesn't make Burry a complete contrarian, because he had $330 million in notional value longs in Google and Facebook. In options, again, probably a few million to maybe a couple tens of millions of option premium. And both those trades worked in Q1, Tesla short and Facebook and Google long. So that's that. Whether he took profits is unknown. Now, Buffett. Everyone's looking at Buffett, Berkshire's filings. It has 0 correlation to Warren Buffett at this stage of the game. This is a commentary on Todd and Ted. Why do we know that? They cut their Chevron stake in half. Warren Buffett said at the annual meeting he'd be perfectly happy owning the entire company, because we're going to need a tremendous amount of fossil fuel through the renewable transition period. They bought Aon, which is an insurance broker that's merging with Willis Towers Watson. They're going to be bigger than Marsh & McLennan. That's a play on inflation and pricing power in the insurance sector. Pricing had been soft. Also the rising rate environment. So I kind of like it. It's up huge, but not impressed by anything in that filing for this quarter. And then Cathie Wood. Interesting thing about Cathie Wood, who's basically bullish on anything and everything that's tech related. She cut her Apple position to 0, which I tend to agree with. I love Apple long term. I think that it had huge margin expansion last year into perfect earnings in Q1, January 26th, and it's never recovered since. It's been trading sideways. Today, Tim Cook testified in the U.S. lawsuit about the 30% extraction fee in the App Store. And Barry Diller was on CNBC. Andrew Ross Sorkin did a nice interview this morning where Barry Diller said that he felt it was basically criminal. I mean, credit cards charge a 2% toll charge. Why is Apple entitled to a 30% toll charge? They add absolutely 0 value to the app developers who do all the work, other than that they have the platform and they built the platform is the other side of the argument. But it'll be interesting to see. I mean, Apple's trading probably like they're going to get a favorable outcome. Otherwise, it would be down a lot further, or it's just simply unknown because the counterpoint of them losing some of that 30% would be so devastating that maybe institutions can't even fathom that. But, keep our eye on that one. And then they've got the EU lawsuit with Spotify, which is the same story. So, any impairment to that, obviously it's not going to zero. Does it go to 2%? Probably not. Does it go to 15%? I don't know. 20%? Either way, the entire growth story, they have zero major growth catalysts, X the services moving forward. Yes, the 5G changeover, but a lot of that's baked in with the multiple expansion from last year. So that's kind of interesting that she shaved that. She bought Twitter, Palantir, Coinbase, and DraftKings. A lot of high multiple stocks are down, in her book, are down 30 to 60%. I think some of them start to get interesting, and we'll talk about that today. But I actually threw out an outlier. I said, look, those three are fine. What I'm interested in, Liz, I think what will prove to be the trade of the year is what Soros did. And we just actually got his filings this week. I've been talking about the same trade for the last week and a half. He did it. And he did it in Q1. So he has a little short-term pain. But I think it's going to prove to be the trade of the year. He swooped in to buy Chinese stocks and also a couple U.S. media stocks, Discovery and Viacom, as far as I know, while Bill Huang and his Archegos fund was collapsing. And that's my kind of trade. I love going in where there's distress and where everyone's puking out. And Soros apparently had the exact same idea. So I think as we look out 6 to 9 months, that's going to be phenomenal. A number of the Ask Me Anything questions deal with that, so we'll dig a little deeper on that as we move forward in this podcast. So, secondly, want to thank. Thank you to Ellie Terrett and to Liz Clayman for having me on Tuesday. Want to thank Giovanni Prati, who had me on CNN. And in this clip, they're talking about a Robinhood type platform that's opening up in the Middle East. And I had a couple quotes in here. The main thing was, what are the biggest mistakes new investors make? And, number one is they try to make too much money too quickly. And they blow up their accounts. That just happens all the time. They think they're going to get rich overnight without knowing anything. It's like going in to do heart surgery without 10 years of schooling and residency and all of that stuff. You're not going to know what you're doing in this business for at least 5 years. And the minute you think you beat the system and you're smarter, you'll blow up your first account. So, but that's not such a bad thing. It's not like, oh, you're not smart because you did that. It's just normal human nature. And it's part of the process. The difference between the people who go on to be successful and well-regarded and do extremely well in this business are the ones that can make it through that process, live to see another day, have enough risk management until they know what they're doing, until they can understand and analyze a business and understand the markets and have been through enough cycles where it's like a seasoned surgeon after 20 years and education and seeing all the different scenarios and permutations that you start to make big money. However, that shouldn't deter people from entering the game because it's the greatest game in the world. It's just take it slow, paper trade, use very small size, use risk management in the beginning, and learn as much as you possibly can. And that was kind of my suggestion there. I had a bunch of others that didn't make it into the clip. Obviously, read Intelligent Investor by Ben Graham. That's probably the most important book. That's Buffett's recommendation, where you understand the mania of the market, and how you can, wait and swing for fat pitches when the market starts acting manic. And that was that. So thank you again to Giovanni Prati over at CNN. Want to thank Saleha Riaz for having me in her Yahoo Finance article on the 18th. So that was 3 days ago. And let's see. So this is very interesting. Crude started trading down, I believe. Let's see. Okay. So she was asking me about oil because I guess oil was up on that day. And I was more interested, people are getting, there were 1.85 million TSA screenings that day. Driving season's right around the corner. There's a period of seasonal strength. But I wanted to point out, with everyone now getting excited about oil when we were pounding the table last year and no one wanted it, the risks are an Iran deal gets done, the U.S. removes the sanction and puts a meaningful amount of supply back online in the short term. OPEC's held steady in its commitment to control supply so far, and the full commercial aviation recovery in the second half of 2021 should keep a decent bid under the market, even if we see new supply come from Iran come online. But no one's really paying attention to this, and this administration has been itching to do a deal with Iran. I think that's probably going to get done sooner than later and surprise the market a little bit. So the other thing that leads me to believe that that will be the case is someone was in the market this week buying enormous amounts of call premium, expecting Brent to be over $100 by the end of the year, which tells me that all this late excited money is going to get the stuffing pounded out of it over the next few months at some point, probably a 10 or 20% pullback, and just shake all the weak people that have reluctantly got into energy and energy stocks, pound them out, and then take off higher over the next 3 to 5 years. So just, I love energy, but I could care less if my positions move against me that are up 100, 150%. If they move 20 or 30% against me, I could care less. I'm diamond hands, as they say. But the new money who just bought, who's been, fighting the trend for 6 months and saying that, we're all going to live on, soy burgers and, electric flying vehicles like the Jetsons, are early in their assessment. So we're going to need a tremendous amount of fossil fuels to get for the mining, obviously, to get us from here to the renewable transition. It's a good thing that the transition's happening because the population's still growing outside the developed world, and we need as much fuel as we can get from any possible source. Moving along. Thanks to Gertrude Chavez-Dreyfus, Sujata Arreo, and Tommy Wilkes for including me in their article on Reuters. So this was the first crypto crash earlier this week. I said there's a lot of leverage embedded into crypto stocks, so there's going to be a spillover effect into equity markets in the short term. And there's also inflation fears as the market thinks the Fed is behind the curve and may have to hike rates abruptly if prices keep rising. So we'll talk a little bit about that. I mean, the Fed has been all over the place. The people weren't happy with the minutes on Wednesday, the Fed minutes, because they said we have to start talking about having a meeting to talk about a plan to possibly talk about tapering. And then you got all these Fed governors out, or regional Fed heads. Bostic's out, and he says, wait on inflation. It's not flashing red at this. Wait about talking on tapering. It's not flashing red. Then you had Sharker talk about possibly, looking at the $120 billion a month of asset purchases, maybe, moving that down a bit. Kaplan was out today saying we need to talk about tapering sooner rather than later. I won't put a date on it. Bostic was out saying we need much more substantial progress in the economy before we even talk about it. And Clarita was out saying economy hasn't made the progress needed to scale back. So effectively, no one knows which way is up. All I can tell you is Powell's in charge. He's basically said, I'll let this thing run as hot as hell until every single person, white, black, Asian, that wants a job, has a job, and we're 16 million people away from that. So he's going to keep his foot on the gas. I think that the jobs report, despite 22 states now canceling the extended unemployment benefits, you still got 28 states that have them. I think the jobs reports will continue to be as aberrant as the last report was, with such a big miss because people are getting paid more to stay at home than to go back to work. I think we'll see a trend of that type of softness over the summer, because for 28 states that are keeping the extended unemployment, it doesn't expire until September. So what that does is it continues to give the Fed cover and say, look, we've got all these people still without a job. We're going to let it run hot. And then all these other guys will come out and gals and CYA public talks and saying, yeah, we know what Powell said, but Powell's in charge, and I think that delays the actual tapering from consensus was Q4. I think that gets pushed out to Q1, and that's when I think we start to see a little bit of turmoil in the markets in the middle of a longer term bull, but enough to shake out all the long money. Okay, so that's that. Thank you again to that group. Also want to thank today Meta Singh and Caroline Valatkevich for including me in their articles. There were two versions out on Reuters. I said the inflation fears are overblown and it's not as bad as the market has been pricing in. One indicator that we can see there are signs of moderation is in commodities started to show some weakness this week. We saw oil come in a little bit, lumber come in a little bit, some of the grains come in a little bit. So I think that's going to be a positive thing through the summer. That's going to enable those groups that got their head handed to them in the last 2 months on overblown inflation fears to start to rally. And what groups are those? I think those groups are tech. Some areas of tech, again, not a wholesale call on tech. And I think some of the yield sensitive, I think utilities could have a second leg, staples, pharma could get bid, and that would be characteristic of this seasonality of the year, where the market kind of goes into the summer doldrums, the market grinds sideways, and then some of these groups start to get bid up that are less tied to the economic cycle and more tied to rates and the absence of inflation fears. So that was that. The other thing I noted was in this quote, institutional investors took a lot of money off the table due to inflation fears in Q1. They're now at $3.065 trillion of money markets. That's the highest since last May. I got that statistic from Fundstrat, Tom Lee's note, and that money could start flowing back into tech stocks as those fears moderate. Tom's still bearish on tech here. I think there are pockets that there is opportunity here going into this part of the season. I do think that on a relative basis, cyclicals will outperform in the first 8 quarters of the cycle. We're 4 quarters in, so I think for another year and a half, on balance, cyclicals will outperform. And we're seeing that this year. Russell value is up 17%. Russell growth is up 5%. I think in coming months, we're going to see that actually, that gap narrow a little bit, even though value will continue to outperform on a year. All right, now let's move to a couple of the Ask Me Anything questions. First off, from Al Padco. Hi, Tom. For your Ask a Question segment, and feel free to edit the question. I'm not going to edit the question, but thanks for the opportunity. Been following you for about a year now and really enjoy your weekly video and daily emails. We've exchanged comments on one of your Seeking Alpha pieces. Last 2 weeks you've mentioned Chinese stocks. Are you buying ADRs or buying them on the Hong Kong exchange? I started to nibble because the things you have discussed previously have made serious money for me. Oh, well, glad to do that, to be helpful. He said, these stocks seem to be very undervalued, but this sector has lots of potential pitfalls beside the political and geopolitical concerns. One of them is the VIE structure, if buying ADRs. The other is the Holding Foreign Companies Accountable Act, which we've talked about actually in a number of these podcast videocasts. Is this a short-term trade for you, or do you see this as a longer-term investment in the way you view energy and financials? Regards, Al. Al, this is a great question. Thank you for that compliment, by the way. And want to just put a bookmark here. First off, anything I do on this, which I always say is opinion, not investment advice. I'm just talking about what I'm doing personally, what I'm doing with my clients. Unfortunately, most people can't invest with me because my minimum is $5 million and it's for accredited investors and qualified institutions only. So I try to give some good value for people who can't, or people, and also for people who are part of the trade service at hedgefundtips.com that can't invest with me, but like to get ideas. So again, click on terms under hedgefundtips.com, opinion, not advice. Now, we are doing ADRs, and I understand the Holding Foreign Companies Accountable Act. There was actually development on this in the last week that the Biden administration actually deferred their decision a couple of weeks as it relates to the 3 or 4 companies that were related to China, that had Chinese military ties. So they had banned China Mobile, I think China Unicom, and one of the major chip makers. And now I believe they're taking the chip maker off of that list. And there has been no indication that they're going to add more names to that list. Now, anything can happen, but I think everyone kind of realized that once this new administration came in, they're going to be much more friendly to China. So far, we've seen that in spades. We've gone from a position of standing behind Taiwan against China to ignoring Taiwan as it relates to China. We've gone from a position of backing Israel in the Middle East to kind of letting it play out as it's going to play out. So it's a complete U-turn in foreign relations. And while that risk is still there of further delisting of those companies that are not necessarily, certainly not Chinese military related, but Chinese government related is pretty much every company. I know that the banks are pushing behind the scenes to avoid that direction, and I think the administration is amenable to more China-friendly policy, which would assuage any concerns about further delistings. My sense is the minute you saw Navarro walking out of the White House with his box, this became a rear view mirror issue. Although you can't say with 100% certainty, and it's right to acknowledge that, you could buy in Hong Kong, then you have currency issues, which is perfectly fine. That's number one. Number two, is it a short-term trade or is it a longer-term secular like energy and financials? This is shorter term. So my kind of view here is maybe 6 to 9 to 12 months. Maybe sooner than that if we get lucky, but more likely 6 to 9 months, end of the year into the first half of next year. And potentially that new decision in early June that was pushed off from late May regarding those less than handful of stocks that have already been banned and delisted will give us some color and could be a catalyst for the entire group to start to rally. Now, you saw some heavy trading on China midweek and a little bit this afternoon, and they coincided explicitly with the crypto crash. The crypto crash today was correlated with China cracking down on Bitcoin miners, using up all the energy. And, obviously they don't like crypto to start with because they're trying to do the Chinese yuan, digital yuan rather, and that's competition. So you could see continued pressure. And every time the Chinese government interferes with cryptocurrency, people will get nervous that they're going to do more interference with the tech stocks. But that's known, and that's kind of priced in at these, for the most part, with most of these stocks down 30 to 70%, and nothing's materially changed in their fundamentals. And we're going to look at a couple of the earnings in a second, despite the fines and the oversight and all of that. And with them wanting to move into an internal consumption economy and spur consumer spending, I just don't see them taking Alibaba out to the woodshed after the $2.8 billion fine, taking them out to the woodshed and shooting them in the head because they kill themselves. Their whole strategy over the next 5 years is aligned with internal consumption, or what they call dual something or other. But obviously exports. But they want to get that and insulate themselves in case foreign governments start to ally together to put pressure on them. They want that internal consumption. And the biggest beneficiary of that internal consumption is going to be Alibaba and their platforms, and some of the others, JD and Tencent, etc. So I still like them. And the other thing is, look, it's Chinese stocks. We're not spring chickens here. You got to buy a basket. You can't analyze a company like we did last year, Wells Fargo, and put 20% of your portfolio in it and sleep well at night. You need that was the biggest percentage weight that we ever did in low to, I think our weighted cost was like $25. You can't do that in China. You need a basket because you got to assume out of, 6 to 10 names that are down 50+%, one of them or two of them are going to wind up being a fraud. I mean, that's just history. That's going to happen. Or there's going to be some short seller come out with a report. And when someone comes out with a report on a Chinese company, it's shoot first, ask questions later. And whether they prove to be a fraud later, like Lutkin or not, it doesn't matter. The stock's down another 30%. So you need a basket to win. And some people have asked me about ETFs. I don't like the ETFs as much because they're not down quite a lot. But A-shares is one that Soros bought in his basket of Baidu, VIP shops, Tencent Music Entertainment, and ASHR is the ETF he bought. I think he bought a number of other China stocks as well after Q1, which we've referenced in past weekly articles and notes. But that's how I'm thinking of it. Basket of ADRs, some with options, some just straight stock, and take an intermediate term view, 6 to 9 months out, maybe 12 months. They could go against us a little bit in the short term, but I think that's going to be a great trade for the second half of the year. Maybe the trade of the year. We'll see. Okay. So thanks, Al, for that question. The next 1, 2, 3, 4, 5 questions can't come from the same person. So thanks to Ben Be Healthy is his name. Appreciate everyone listening in. And his first question is, how much geopolitical risk is there regarding sanctions, stock exchange delistings, regarding Baba, A-share, etc.? We just went over that, so that's an easy one. Good question. Okay, another podcast question. What are your latest thoughts on DFEN? Okay to add at 20. If not, what's a good pullback price to wait for? Thanks, Ben. So this is part of the group that we were pushing like crazy last year. It's up quite a bit. We, again, prefer individual names versus ETFs. But, something like DFEN, I mean, first off, this is a triple leveraged ETF. So, these things are going to bounce around. So what's that? $22. If you bought it now, the thing could go down to $15 before going up to $50. But who cares? I mean, is my view. But if you can't take that type of volatility, I'd probably be more inclined to buy Boeing here. Personally, most of the other names that we talked about last year are up huge. We'll take a look at a number of the charts. But if you want to buy this, who cares if it's $20 or $21? If over time it's going to work its way up to 40 or 50 or maybe beyond 70 in the next 3 to 5 years, if it goes 25 or 30% against you, it's not the end of the world. For safety, buy the individual names. The one that's still buyable at these levels with new money is Boeing, in my opinion. But we still own a number of defense and aerospace. We like the sector going forward. Again, that's the longer term, like energy and financials. Next question from Ben Be Healthy. Hi, Tom. What are your thoughts on XLF short term? I know you love it long term. Short term, I think it's going to cool. Honestly, over the summer, this would be a spot you can lighten up a little bit and add back later, or you can just hold it. I mean, the time to sell financials is going to be during the next yield curve inversion, and then once you get the 2 to 10 inversion and credit's choked off, you probably still have another 6 to 18 months historically where they still go up even after that. But for safety, next time it inverts. So my guess is, your Wells Fargos are going to be $70 or $80 stocks at that point. Maybe it'll hit the century mark. I don't know. Your Bank of America's could be $70 stocks. Your Cities will be $100+ stocks. So there's a lot of room, but in the short term, could we get a 20% pullback because now all the late money that was making fun of the trade last year is now buying the breakout? Yeah, because this is the time that the market tends to smoke those people that are late monies and are all exuberant after the 100% or 150% of the move has already been made. So short term, I'm cautious. Could it keep pressing higher? Yes. And would I be happy with that? Yes. But do I expect it to move against us a little bit over the next few months? Yes. So also, you said on last week's podcast that market makers sold tons of protection on Monday through Wednesday last week, which will expire worthless. Thus, should we expect the markets to be up this Thursday and Friday, since Friday's options expiration date? It may be too late to answer the second question for the podcast. Okay, number one is I would never make any assertion about what's going to happen in a week. That is a formula. This is an example of what I was talking about on the CNN piece, is with new people trying to make too much money too quickly. If you're trading on a basis of a week, it means you're buying weekly options. Like, honestly, the product's made for weekly options are made for retail suckers. So anytime you're buying a weekly option, just assume that someone smarter than you is taking your money. Because while there will be instances where you'll make 5 and 10x on penny options, when all is said and done, you stayed for too many free drinks at the casino, and you're going to walk out of the casino with your mortgage payment left with the dealer. That's how it works. So, I think, we've seen a number of these type of questions, short-term questions before. Wrong podcast for this. Anyone that tells you they have an edge over the next 5 days, they're probably not going to be around a year from now. So, what I did say was that the option skew index, let's just see if I can pull this up. Yeah, okay. So was elevated, and they're selling a lot of out of the money premium, insurance premium that was very, very expensive because there was huge amounts of demand for it. The at the money implied volatility was low. And the out of the money was in huge demand, betting on 1 and 2 standard deviation moves. That doesn't mean for weekly options. No institution's buying insurance a week out unless they're morons. So they were probably buying a couple, 1, 2, 3 months out. S&P 500 puts 1 or 2 standard deviations out, betting on a catastrophe that never came. And if you recall, and you can go back to the articles, I said that will probably get a move against you, but just enough that it doesn't pay out, because a 1 or 2 standard deviation move is probably closer to 10+%, and which means you're more likely to get 3 to 5% in the S&P. So no one gets paid. The sellers of the premium make all the money, and the buyers of the premium that bought after the storm started make nothing. And that's exactly what's happened so far. Does that mean it can't change? No, it could certainly change. But for now, it's playing out as anticipated. And please, for your sake, do not trade on what's going to happen in the next 5 days. You're guaranteed to blow up. Now, that's part of the tuition process. Maybe you have to blow up an account or two before you learn your lesson. And I'm speaking generally to new people, and that's okay. Physicians have to pay $150,000, $200,000 of student loans to get their education. But my suggestion is take your time horizon out a little bit longer. You'll do a lot better in the long term. And don't be in such a rush. Learn. And by the way, that's what you're doing by listening to this. So, huge applause. But I know you've asked a number of short-term questions in the past, and I'm just telling you it's going to hurt you more than help you. Even if I know the answer, which in some cases I do, or I think I do, it's not helpful to talk about that short-term time frame, because if you just look out a little bit longer, you're going to make a lot more money and have a lot more certainty in your results. Next question. At what price do you like adding Alibaba shares? Here, right here. I love adding Alibaba here. I love adding BABA lower. I love adding BABA if it starts to go back up. I don't know where it's going to bottom. It could bottom 10% lower from here. But I think 9 to 12 to 18 months out, it's going to make new highs. So what's that, a 40, 50% move? I could care less if it goes against me in the short term. So yeah, I'm adding here, and I'll continue to do so, even with new capital at these prices. Again, that's opinion, not advice. Next question, same questioner. Here's my most important podcast question for the evening. It seems like you think the COVID vaccines will work and make things great. Maybe you're 100% correct. But what if, for whatever reasons, variants, vaccine complications, or something else, there are excess or excessive deaths in coming months? Of course, I hope this doesn't occur, but what stocks would help hedge one's portfolio against this? Specific sectors, healthcare stocks, what else? What do you think about TDOC down 50% from this Friday? Okay. I think this is the right question. You can never be too certain about your thesis, and the minute you do, you're dead. So I like that you're asking this type of question, Ben. So the types of stocks that would hedge us from this, well, first off, if the world is coming to an end, you generally want to buy long-term Treasury bonds. But let's assume that's not the case. Let's just assume you get variants, or the vaccine doesn't, or it could be a geopolitical event, just some black swan that no one's looking for. The stocks that I put out at the end of February and the first week of March that have done well, now have taken a rest the last few weeks, I think are going to take another leg higher, will benefit in that type of environment. And that's namely utilities, staples, and healthcare. And we're going to talk a little bit about those today, but those are your defensive groups, utility, staples, and healthcare, that are going to do well either in a sideways chop or in the scenario that you're laying out. Now, you also ask a great question about TDOC. So I pulled up the chart here. Now, the problem with these high multiple, no earning stocks is that everyone loved them 100% higher. Now, no one wants them at 50% off. However, when you look at Teladoc, it's 50% off, but basically what's happened is it's gone from 20 times sales to 10 times sales, and it still has no earnings. So what's the story here? I mean, it ran up huge on Teladoc is, getting your physician services over the phone or over the internet without going into the office. I think a lot of people are going to go to the office to catch up, number one. Number two, the perception of that trade, like the Zooms, is in the rear view mirror. So I think they have to come to a new equilibrium, a new multiple that's not assuming unlimited growth and is not assuming future quarantines. And I don't know what that equilibrium is. So on Teladoc, I have zero edge to know if 10 times sales is the right multiple, 20 times sales is the right multiple, or 1 time sales is the right multiple. I really have no way of telling because there's no earnings, and I don't know if the growth is going to come in line with expectations. But, all I would do on something, so I would just take a pass. You could be right, because I do think there are a lot of stocks that are cut in half in the last couple of months that will bounce once these inflation fears subside. So I like your line of thinking. They just broke through. I'm looking right here at this chart at buyers volume by price, and I don't see any real support here until $82. So it's at 140 now. I could wake up in 3 months and this thing could be back at 100, and that wouldn't surprise me. I could also wake up in 3 months and see it down at $80, which perfectly wouldn't surprise me. I'd probably start to be a buyer at $80. I'd have to take another look and see if the projections are still the same. But this is where I think there would be a lot of institutional defense. There's a lot of activity here. There just doesn't seem to be, what's the reason for anyone to step up here? There's no real ownership. It's broken below all support. So I don't make trades on technicals, and that's all this would be, exclusively on technicals. That's for damn sure. So I don't have an edge here, so I would just personally take a pass. I'm agnostic, but I would definitely take a hard look at in the 80s, but I may never get to take that look, and I'm perfectly okay if it turns around and makes new highs without me. So I don't have a good answer for you, but it's a good question. Okay, so this was, by the way, this is what I was talking about. Bets are soaring that oil hits $100 by December. So now they've got everyone back in the boat. My guess is this is the exact time where that premium gets burned. And we get the Iran deal, and oil, comes in $5 or $10. Everyone starts puking out. And, if we've got some new cash available, we'll be buyers. But we're going to look at the energy stocks, and you're going to look at a bunch of them that still look really cheap right now. So maybe these bets on $100 Brent by December are correct. I doubt it. I know that has to happen to accelerate the transition to electric, but I don't know if it's going to happen that quickly. So I think short-term caution, intermediate term, it's going to be an awesome run for the next handful of years. Okay, the stock market is a device for transferring money from the impatient to patient. So I guess that's speaking to the short-term question here. I think if you just take a longer-term outlook, you'll be amply rewarded. But these were just phenomenal questions, and I want to acknowledge both Al and Ben, because I can just tell that they've been really paying attention for the last months and year plus, and in the case of Al, making a ton of money from it. So kudos to you. The other aspect I want to point out is nothing I'm saying here is meant to be like, smart or someone smarter or any of that. All it has to do with is experience and learning through experience. And sometimes all there is to that is time. You can cut your learning curve by learning from someone who's experienced, but most of the people who are experienced and know what they're doing aren't willing to share what they know. So that's the other catch-22. I do this part for self-interest and part to give back. The self-interest is going on TV and, getting quotes in articles and doing this weekly podcast takes a tremendous amount of ongoing rigor and preparation. And what happens is the returns for my clients and for my personal have been through the roof because of it. So doing this type of work benefits everyone, but it specifically benefits my clients and me because our performance is off the charts because of the rigor I have to go through on a daily and weekly basis to put this amount of content out and being on top of every single thing that's happening at all points in time, which just has translated into outstanding outcomes. So the point of this quote with Charlie Munger, it says a lot of people with high IQs are terrible investors because they've got terrible temperaments. So that question about Baba, and DFEN, would you wait for another dollar to buy? I'm a buyer of Baba here. If it goes another 10 or 20% against me, I'm a buyer of more. It was the same thing with Wells Fargo. We started buying some in the high 20s. It went down to the low 20s. Our average basis was 25 or a little bit below 25. Now it's at 46, 47. So, and now everyone wants it, and hedge funds are starting to buy it, etc. So it's just, it's not about being smart. It's just going through the experience, being open-minded to continually learn. I'm learning on a daily basis and getting better on a daily basis. And, so I invite you to do that. And, if you get a trade wrong, it doesn't mean you're not smart. You may have a much higher IQ than some of the best performers in the market. It's a temperament game. And oftentimes the best business people are the worst investors because they, a lot of success in business is just sheer will and grit. So you force through and you're stubborn and you keep going until you make it happen. And if you do that with a trade, you're toast. You blow up a portfolio by not being flexible in your thinking. So I would just, go easy on yourselves is what I'm trying to say. It's a process, and try to have some fun with it. Try to manage your risk, and as you go through time, you'll become great at it. There's no question about it. So okay, so speaking to the trade of the year, this was the headline this week. George Soros buys stocks linked to Bill Hwang's Archegos collapse. One man's trash is another man's treasure, I guess. I love these forced liquidation situations, so they listed that. And we're in the same exact trade, maybe a few different names. And then you saw earnings from Chinese companies across the board. JD beat both on the top and the bottom line. Baidu beat on the top and the bottom line. Tencent beat on the top and the bottom line, in spite the Chinese government crackdown, which is known and already largely, we hope, mostly priced in, which we believe it is. So, and then Gavacal, which is one of the best Chinese analysts out there for the last couple of decades, says, don't bet against China's investment-led growth model. So people have voiced concern that their growth is slowing relative to the U.S. in the short term. That's because their recovery was much faster than ours. We've talked about that for the last year and a half, that they were 3 months ahead of us. It's the exact same story, but moving forward, as our growth normalizes, they're still going to grow at about 2 times in the short term. I think in the long term, they are going to face demographic headwinds. And when I talk long term, I think they could have more of a Japanese situation 4 or 5 years out than people are anticipating. Most people are betting that they become the new economic hegemonic power globally. I think that's unlikely because I think our demographics are more favorable. And while in the short term it will look neck and neck, I think in the intermediate term we're going to pull well ahead, because we never had the one-child mandate, and that's really turned them into an aging population that could impair them the same way it did to Japan post 1989. Okay, now this is interesting, because now we've been talking the last week or two about buying some of these, not wholesale tech, but some pockets of tech that have been sliced in half, which Ben alluded to in one of his questions. Biggest shorting of tech stocks by hedge fund in 5 years. So this is the kind of headline you want to see when you're going to get an inflection, like in 18. I'm sorry. Okay, so this is late. No, so actually this is more interesting. They're showing the biggest short flow has happened in the last 2 weeks. So after half of these names are down 50%, the hedge funds have now jumped in and gone short, which is explicitly why hedge funds had another dismal quarter. Goldman explains why. So first, they were in their hedge fund hotel stocks, which you can see the highest weight, 50 stocks that most frequently appear among the 10 the largest holdings of hedge funds. This was for Q1. So what were they overweight in? They were overweight in tech. What got taken out behind the woodshed and shot in the head? Tech. So now that they've gotten smoked and underperformed in Q1, what are they doing? They're shorting in the hole is the, what this phrase we use for amateurs that short things that are already down. And they're going to get smoked again because we're coming into a period of seasonal strength for technology. If you look here, this is the average of the last 20 years by equityclock.com. Sideways for the first half, straight up for the second half. I think this year is going to prove to be in line with that tendency. Now, so I like this. I like when they're extremely long oil, because that tells me oil is probably ready to take a break, probably right after Memorial Day. Prices always ramp into that and then they fade. And then you look here at some of the Sas stocks starting to get upgraded. Salesforce got an upgraded by Morgan Stanley this week. That's been, that stock has been struggling. I think some of these type of stocks could start to get bid. Same thing from Bank of America, upgraded them. And here's where we put out last week the 10 indicators of the Nasdaq, where we're saying this is pointing to much closer to a buy than to a sell. And here were the indicators that we put out. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. And they were all near the bottom versus the top. Did that mean that you had to get an immediate turnaround? No, but we actually did. So the timing was pretty good. And this is what you see. Then we retested this week, and now we closed positive. By the way, the Nasdaq actually closed positive this week, so that's pretty damn impressive. And so that's where we are. So this is where they were all along, the hedge fund hotel in Q1, and now as they're all blown up, now they're all shorting in the hole, and now we probably get some strength as the inflation fears are overblown. You're also seeing some buying coming in. The reason I picked this one, this is Open Door Technologies. This is one of those SPACs that, I've been talking about warrants on busted SPACs. Well, this is not only this is all three things. This is a tech stock, market hates it. This is a SPAC, market hates it. And this is an IPO, basically, market hates it. So these are the three bubbles. They've rolled over. The stock got up to, $39. It was a SPAC at $10, shot up to $40. Now it's shot down to $13. It's trading about $14. Well, guess what? This guy came in, one of the directors, he bought $1 million of stock 2 days ago. So that's kind of interesting. I see that type of stuff and I get interested. $998,000 of stock, 67,000 shares. Puo Kufer is his name. He's a director. And, am I saying that that's the one? Do what you want. But I will say that I'm seeing a little bit more of this. I'm seeing also, we saw in the options market today, someone came in with some Baba calls, Alibaba calls. I think it was November or December, $200 strike. That's a smart trade in the money. So that's that. Here's the note on 22 states dropping the $300 weekly unemployment boost amid mounting job shortage. So that will help those jobs report and maybe push the Fed toward tapering sooner than later. But with 28 still holding strong till September, I think we're going to continue to see below estimates, on balance through September, which pushes that taper action off into Q1 instead of Q4. Okay, moving right along, we are at the May Bank of America Global Fund Manager Survey results. We've gone from everyone believing this was late stage bull to now everyone starting to move over to thinking it's early stage bull, which we've said since April of last year. And these are some things. The consensus is now expecting higher growth and higher inflation. So I would be, this last big spike was in 2011. And that's when you had the twist talk and yields compressed pretty quickly. So that's why, some of these overzealousness coming into what we were pounding our table on last year, that's up 100, 150%, energy and financial stocks, etc. With everyone looking for this, I think in the short term they take a breather. And with everyone shorting tech in the hole, I'm inclined to say there's going to be opportunity there over the next few months. And with no one wanting to touch China because of the fear over this China delistings, which I think are contained to those handful of names and may get a catalyst in a few weeks that there will be no further delistings, that could be an opportunity, which is kind of tied into tech. If you notice, China was a little heavy today after the Chinese government crackdown on the miners because it's just, reminder of that it's a communist government and they can do whatever they want. But if they were to really impair Alibaba and Ant Financial, Ant is going to be critical for their entire Chinese yuan rollout. So if they want to do that, they basically are trying to shoot themselves in the head, and no one in their right mind does that. So my bet is that they have already inflicted the $2.8 billion fine. That's the end of the story. Alibaba goes and plays golf. He doesn't show up on, not Alibaba, what's his name? Jack Ma goes and plays golf. He doesn't do any interviews. You never see him on TV ever again. He gets a scratch handicap, and all is well. And Baba goes back to new highs in the next 12 to 24 months. Okay, some other key takeaways from this. Investors think S&P will outperform in 2021. So now here's what they all think is going to do the best. They've all moved. Now everyone thinks the S&P is going to do great. Oil's going to do great. Emerging markets are going to do great. So this is a complete change from 6 months ago, which is, why you're seeing these huge bets on oil, which makes me pause in the short term, love it in the intermediate term. But when late money gets that crowded, they are often taken out behind the barn, and what happens next. All right. Fed hike expectations pulled forward to 2022. So now they're thinking, Powell had said 2023. That's where everyone was last report in April rather. Now it's the opposite. They think it's going to be in 2022. I don't see him raising rates at least till the back half of 2022 and maybe even 2023. He will taper before then, but I think that's a 2022 story. What else do we see here? Bets on the infrastructure package. They're working on that. Now, people have viewed these three charts: profit expectations, investors expecting a stronger economy, and level of risk you're taking in the current environment. All are at or near all-time highs, which looks like complete euphoria. However, if you dispassionately step back and look at this data, all the times that they hit these euphoric levels were not at the end of old cycles. They were coming down into the end of old cycles, coming down. It's right at the beginning of a new cycle, right at the beginning of a new cycle, right at the beginning of a new cycle. So you saw this type of euphoria in 2003 and 2009. So this is normal. Now, it was also normal in 2010 to get a 10 to 20% correction to knock out some of this exuberance. And I do see us getting that more likely in 2022 than 2021. And I think it's going to line up with the first tapering in the first quarter or the first half of next year versus this year. This year, as we said in the beginning of the year, was going to be, I think, a 2013 or 2017 type model after a huge, massive dislocation like you had in 2011 and you had in 2016, just as we had last year in 2020. The year after, no one believes it. Everyone's looking in the rearview mirror waiting for the next shoe to drop, and that's why it keeps pushing higher and not letting anyone in. What does that look like? No corrections greater than 3 to 5% in the S&P 500. So far, that's been the case. We've had, I think, 3. We expected a handful for the year. And we expected a mid-teens upside year. So we're not expecting more real miracles in the general indices through the year end. We should get some more upside. But the real money, the big money, is going to be made in the rallies under the surface. And we're going to talk a little more about that. This is going to actually be a long call. We've got a lot of good stuff to share with you. So for those of you who are on the podcast, we're at minute 57. You're going to get cut off in 3 minutes. You can go to hedgefundtips.com, click on the VideoCast, and fast forward the YouTube video to minute number 60. And you will pick up exactly where you left off to get the last 10 or 15 minutes, which is going to be filled with charts of a lot of different sectors and stocks. There's just so much to cover this week. Despite nothing really happening in the market, there's a lot to be getting yourself prepared for. The other thing that I loved about this Bank of America Fund Manager Survey was this Z-score on tech, meaning the allocation dropping to the same magnitude it did in 2 times that preceded tech rallies. And we'll look at that in the article of the week a little bit more. You're also seeing all-time high in boom expectations. Look at what the biggest positioning versus history in the Z-score. Commodities have had the biggest change. Everyone's now bullish on the pound. Banks. I mean, these were the things you couldn't give away 6 months ago that we were pounding the table on. Now they want UK stocks. What are they getting out of? They're getting out of bonds. They're getting out of tech. They're getting out of utilities. And staples has been light as well. I think that's going to be where the money could be made over the next few months, but we'll talk about that a little bit more. The other thing is month-on-month percentage change in investing positioning. So big move into energy. There was a move into staples, so there is some level of people getting a little defensive, which is interesting. They've also had that monster run from early March to the first 8 weeks. Then they've cooled off for the last 4 weeks after all this hot money came in. I do think they could take another move higher in selective cases, and we'll talk about that. Where have they gotten out of? Emerging markets and tech. So we'll keep that. Most crowded trade is now moved to long Bitcoin, which is kind of interesting. Now we got this, whatever it was, 30 some odd % crash. Well, no, it crashed from, what was it, 60? Did it get to 68? I have no idea. I don't watch Bitcoin every day, but whatever it was, in the 60s down to, I think it hit 30 midweek, and then it got to the high 30s or mid 30. I think it's at 35 right now. So about a 50% correction right after everyone crowded the boat. Which again, they always take care of the late money. That's how it works. And okay, so long Bitcoin is the most crowded trade. People have really come down. They thought that tech was crowded last month. Now they don't think it's crowded, and they're all shorting in the hole according to the other data we looked at. Do they think Bitcoin's a bubble? 74% think it's bubble, which is kind of interesting. If you recall, we talked about tulip mania, where the price of a tulip bulb hit the modern day equivalent of an average home. It was Rembrandt's house in the middle of Amsterdam, which would be modern day equivalent to 350,000. So, like that Teladoc story, I wouldn't be surprised if Bitcoin went to 250 or 350,000 before it's all done. I also wouldn't be surprised to see it go to zero. Well, I wouldn't say zero, because you could still get a tulip bulb for $1, but 400 years later. So anyway, I just generally don't play there. I just, I can't, if I don't have an edge on intrinsic value, it's just gambling, and I'll leave that to other people who can make it. There are people that make a lot of money gambling, but that's not my knitting. Okay, so biggest tail risks are inflation. Again, this is the overblown inflation that's taken tech out to the woodshed. I think that creates the opportunity. And then some takeaways. So you can review that on the website. Now, here are some indicators that we take a look at for short term just to get a feel. This is the PMO by all percentage of stocks on PMO crossover, which I think PMO is kind of like a MACD type of thing. It doesn't really matter. The question is, does it correlate with bottoms and tops? And the answer is more often than not. So we're getting much closer to a buy point than a sell point. Could we have some more pain here? We sure could, but odds favor buying some of those things that are beaten down versus selling in the hole. Same thing with the PMO by SPX. This just deals exclusively with S&P 500 stocks. Again, you get down to the low 20s here. You're often paid better to be a buyer than to be a seller. Not all cases, but most of the cases. So, that's why I'm not a general indices person, but I do see opportunity under the surface. BioNTech says COVID vaccine likely to be effective against Indian coronavirus variant. So that's good. Pfizer said the same thing. Pfizer's our biggest pharma holding, followed by Novartis. We were putting it out at the end of February, early March. It shot up since then. We think that it has more to go. Now we're looking at large cap pharma. This is Novartis. It's gone up, but it's been stalling here for a few weeks. We think it's got a lot more upside. We think this will eventually work higher over the next 6 to 9 months, maybe sooner. The story is going to be second half doctor's visits. The majority of their scripts are in person, and we're going to see those boom again now that people are vaccinated and go back to their doctors and start to worry about heart disease, cancer, and the top 3 killers, diabetes, and all those different things. So we still like Novartis, but as you can see here, these are weekly charts. A lot of these can have significant room to run. So we like Novartis. We still like Pfizer. We like Glaxo. I think Merck is an opportunity. Maybe Biogen, Gilead. So there's good opportunity. And these are defensive groups, and they pay a dividend in most cases twice the 10-year yield. So you're paid to wait. Our second defensive group that we put out at the end of February, early March, which has had a huge bounce, is utilities. Our biggest two there are American Electric Power, which, as you can see, it rallied huge. It's been consolidating for the last few weeks. We think it's got another leg higher. So you can see these things have, these are kind of like the last bastion of opportunity that's not up 150% off the lows. I mean, the general indices are up 90%. Off the March lows. Most of that was made in the first 3 months, but nonetheless. So we like Dominion. We think that's got a second leg here after this consolidation. We like and own both Dominion and American Electric Power, but there are a number here that could work. I guess Eversource, that's Connecticut. We don't like them. They send us a big bill every month. Let's see. And so utilities are still good. we're hodlers. And there are some that you could probably put new money to work in, but you got to, look through them carefully. Moving on. This is another defensive group, consumer staples. This is the packaged goods. We have Kellogg, again, from that early March. Let's pull up a weekly here. So we put that out the last week of February, first week of March. It's gone straight up. It's consolidating. We think it's got another leg higher. We also did Campbell. We think you can put new money to work here. We own that. Maybe we'll add some to that. And then what else do we have here? This is consumer staples, household and personal care. Kimberly-Clark, we love here. We would put new money here. We would put new money in Clorox. We own both. And so those have basically done nothing since the end of February, early March. I mean, they're up a little bit in 2 months, but, not really. Clorox is not. So those are some places we would put new money to work. And now we're on to energy. This is weekly charts. Let's just take a look at monthly charts just to give a little perspective. So, energy transfer. I mean, these things will work their ways higher. It's not to say, Continental, this thing will definitely double over the next 3 to 5 years. There's no question about. Question right now is, are they going to take the new eager money that came in late after it's up from 10 to 30 out to the woodshed and take it back to $25 and shake out that late money? I don't know. I mean, some of these things are so beaten down, they might just keep powering higher. So it's not something we have to worry about. We did all of our buying last year, but, Occidental. So, you can see there's still tremendous Suncor, Royal Dutch Shell. There's still tremendous opportunity for these to work higher over the next 3 to 5 years. Even Exxon has had a huge run, doubled, but, again, and pays a beautiful dividend. So, still great opportunity here. So any pullbacks in our view are buying opportunities. Again, opinion, not advice. The banks, which no one wanted, which we were like pounding our table on, have had huge runs. I mean, Bank of America. So I think you could see that scenario where the inflation fears are overblown, yields moderate, people worry about the yield curve, banks maybe cool off, but they're also probably selling up into the stress test, running up into the stress test, because they're going to pass with flying colors and be able to do more dividends and buybacks, and the market's sniffing that out. So maybe we get a little more juice before a cool down. But I do think some parts of tech are going to get bid this summer, and more likely than not, these will take a rest in the face of that on a relative basis. Here's the defense and aerospace. Ben asked about DFEN. So you can see these things have all just ripped higher. We were pounding the table. You can go back and look at our articles right before the election. They've just gone straight up since that period. We think these obviously still have more upside, like a Lockheed. I mean, Raytheon, this is a huge move, 50 to 85. But I think the one that I'd put new money to work today is Boeing. I think that looks great here. And the rest, I'm a hodler. Okay, here are some Sas stocks. We like Splunk, and we own Splunk. So we've been buyers of that in the last couple of weeks. We'll keep buying if it goes lower. They're going to report June 2nd. So, maybe it trends down into earnings. I don't know. I think we're going to see some Sas earnings next week that'll probably be better than expected. Alleviate some fears, and maybe this whole group gets a bid before them, or we wait for earnings. But either way, we like that story. We've talked about it in the past. There's also, let's see. So there's not a million stocks that we're like pound the table on in Sas, but there are enough that are interesting to us. I think, even some of these super high multiple stocks are getting tempting at these levels just because there's so much despondency about it from everyone who loves it to the amount of hate that's in, even at ridiculous multiples, maybe even his Teladoc. But it's just not my knitting, so I stay away. But there are a few spots that I can put a decent enough size to work so that if the whole group moves, we outperform it that way. Here's some Chinese stocks. So this, in my view, I think we've still got the best opportunity, risk reward moving forward. That's not to say it won't move. You could get a bad outcome in 2 weeks it could flush down 10 or 15%, and then that's the final bottom. But I don't know. There's a lot of bad news priced into this. I was on, I think, a week ago talking about Baba, and the other guest on it was like, well, you got to watch out for the government. No kidding. Like, Captain Obvious, thanks for the advice. Like, that's why the stock's down 40%. We know that. So, so anyway, the point is, this week, these stocks started to turn. Some of them, like the IQs, Beely started to turn. Lee started to turn pretty big. That's a electric car company. VIPS, that's one of the ones that Soros bought, is still showing weakness. But, I think it's just a matter of time till we see some of these things start to turn really abruptly. And whether that's the catalyst or not, I don't know. Tencent Music Entertainment, that was one of the Soros ones. XPEF started to turn. We've talked about that in the last 2 weeks. JD, PDD. So, these are pounded and they're starting to turn. Baba, it tried to turn this week. It's up. It's obviously had a higher close than last week, so that's a good thing. But this is the one that I think, for our money, if you look out, just if you separate the sum of the parts, their cloud business at the growth rate that they're having will exceed AWS within 3 to 5 years. Then you take the internal consumption initiatives of the Chinese government. I mean, everything is lined up. Their interest in Ant Financial, and that'll probably get IPO'd. Jack Ma out of the way. So I like it for a lot of reasons. And to Ben's question, if it dropped to 200 or 180, we'd be buying it hand over fist. But we're adders here. We like it here. We think it probably turns sooner than later. But like Wells, it could go against us before it goes for us, before it doubles. So what? And that's the difference between the stock market being a device for transferring wealth from the impatient to the patient. The impatients are like, oh, it's below my stop, I'm out. But because they don't know what they own, and they know the price of everything and the value of nothing. Once you understand the intrinsic value and you can analyze a company and have an understanding of where you are in the cycle and just experience these things, you'll start to see them over and over and over. And you can never be 100% certain. So you never put yourself in a position where they can take you out in a stretcher. You always have to have some level of risk management. And usually that risk management is by sizing more than anything else. And that's that. Okay, so this week's article of the week, the weekend's Save Your Tears stock market. Obviously on Wednesday night, when I wrote this article, it was the crypto crash, all the tech was weak, everyone was scared, the world is ending, and I said, save your tears for another day, and we're going to walk through why I had that assertion. Whether it will prove to play out or not, we'll see. So far it is. But all we can do is look at probabilistic data points and apply different weights and make bets on that basis and manage risk. And that's exactly what we did. So the good news is we've gone through a lot of this so far. This was another statistic that Macro Charts put out. That its Nasdaq newsletter exposure has plunged at one of the fastest rates in history. That reflects a remarkably quick rush for the exits. Previous cases led to the Nasdaq gaining 5.3% over the next month on average. So I think that's a really useful indicator, and that's kind of in line with how I'm thinking about things. And it's also in line with what we discussed from the Bank of America Fund Manager Survey that showed the Tech Z score. And to top that off with the Zero Hedge article, which showed Goldman Sachs showing that hedge funds are now shorting it at the highest pace, which tells me they're shorting in the hole. The boat's getting crowded short tech after they got caught long tech in Q1 and underperformed. So here are the last 4 times that the Z-score on tech got this low, and every single time was at or near a bottom in tech and an inflection point. So we'll see if that holds true this time again. We covered this exuberance and why that's normal in the beginning of a new cycle. We talked about the institutional money markets funds have gone up to 3.065 trillion, which is the highest since last May. They've been building a ton of cash, which means as we get this reversal, they'll have to chase up. That was also reflected in the, let's just see where the National Association of Active Investment Managers finished this week. So, okay, great. So it's down to 44, which is perfect, because what that shows us is that as the market reverses, they're dramatically underweight. So they've been underperforming. Now they're underweight. They're shorting tech in the hole. So guess what has to happen to cause the most pain to the most people? Tech has to rally, catch them not only underweight tech, but short, which means they got to flip quickly and force this exposure back up to 100% quickly. That's the likely outcome. Fear's back in the market at 35. That's also a good setup. So, these are all probabilistic. Our message for the week, we continue to pick our spots for the rallies under the surface. We spent the last couple of weeks building up China positions, selected SaaS and tech positions, and SPAC warrants. Mostly selective busted SPACs with announced deals that have already rolled over, but have interesting businesses and sponsors for the long term. You can explore a list of completed SPACs here. And then, okay, I'm in the minority. I think last week's jobs report gave the Fed cover to push tapering out from Q4 consensus of 2021 to Q1 2022. We discussed that. That's when I think we'll get our first larger correction of this new bull market. Lower probability beforehand. In the meantime, we buy where we see dislocation and don't expect much from the general indices. We believe the big money will be made under the surface for the rest of the year. So for now, you can save your tears for another day, which was The Weeknd and Ariana Grande song. That was the theme of the article. So that's that. The other thing that's interesting about, we've gone through the China stocks, etc. What's exciting is Soros was in the middle of the fire. The house was on fire and he was buying that. But right now you can put on the exact same trade that we did and he did at the same price or better. So in other words, you didn't miss anything by having the edge that he had with the information that he had at that time. Because usually it takes a little time to form a base after you've had a heart attack. Someone has a heart attack, they don't come out of the hospital in an hour. It usually takes them a week. And then, they start to catch their breath, and then they can go back and regroup. And in the case of some of these Chinese stocks, go on to make new highs over the next year or two. So that's that. This was the option ticket we saw come in at the end of the day today. Someone put a bunch of 200 in the money calls for November on Alibaba. We like that trade. Then we did biotech earnings this week. The cumulative earnings power for 2021 actually came down 4.9%, but 2022's up 5% and change. Biotech's kind of like a spotty. You could have one company, that takes $20 off their estimates and kind of skews the result here. But we think there's a lot of opportunity, not only in big pharma, but in some of these large biotechs that we covered. Here's the passenger throughput, 1.7. It hit 1.85 earlier in the week. So these are good numbers. They're still down from 2019 when it was over 2.5 million at this point, but we're working our way back with 63% I think of the population having one vaccination thing. So that's that. Estimates went up this week, but at a slower pace, so only marginally less than $1. So it's still going in the right direction, but it's slowing. I think that kind of fear, peak growth type of narrative you'll start to see that will contain yields and probably put in a bid for tech over the summer. As far as the economic data this week, Empire State Manufacturing was better than expected. Building permits missed by a hair. Housing starts missed pretty big. That probably was attributable to materials costs. They're probably delaying the starts. But those are starting to come in. Crude inventories were better than expected, but still 1.3 million build. Distillates were a huge draw, so that's still bullish. But again, just watch out for that Iran deal with this administration. Continuing claims. Again, the media continues to celebrate the initial jobless claims, which are meaningless. The continuing claims are still missing expectations almost every single week. So That's not a good sign. I think it's fully attributable to the extended unemployment, and that's going to stay till September, which makes me think the Fed has cover on the taper until next year versus everyone thinking it's going to be this year. This is the number you want to see beat, not miss. I don't care about the initial jobless claims. This keeps missing, so that tells me taper can be later for now. Facts could change. I'll change my mind, but that's where we are now. I've been talking about it for weeks. Manufacturing PMI beat, so that's good. Services beat, that's good. Existing home sales were a little light, so keep an eye on that. So that's the story for this week. It was longer than normal, but I gave you a lot of meat and potatoes. I hope you found it helpful. Hope you'll be able to take advantage in some way and make a lot of money over the summer. And in the meantime, again, this is opinion, not advice. But look, have a great week. Make it a great one. I believe next week I am traveling, so it will probably be Thursday. It may be Friday. I'll keep you posted. But anyway, you'll get the email and the text message. If you're not on text messages, go to hedgefundtips.com on the right side. I'll just show you where to sign up for text messages so you can always get it as soon as it comes out. Sometimes emails, don't get through. But if you sign up for Hedge Fund Tips Text Club right here, it takes you to it. We don't sell or transfer your information. We just text you right away. You're the first to get the article of the week, the podcast, and the VideoCast. So it's 3 texts. You can unsubscribe whenever you want, and it costs you nothing other than if you have to pay for text on your phone. But if you have unlimited text, it costs you nothing. So with that said, make it a great week. Thanks for listening in, and have a great one. Bye-bye, everyone.